Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of April. I'm going to be using the Thackeray's 2023 Investor's Guide as a reference for this part of the video. If we look at the April summary page, we can see that for the month of April from 1950 to 2021, April has been the second strongest month of the year. So in other words, it's one of the better performing months of the year. And if we take a look at this graph over here, we can see that on average, this shows the average gain for the month of April from 1950 to 2022. Every year is different, of course, but this is the average. You can see here that the S&P 500 for the first half to two-thirds of the month tends to be positive and perform quite well. And let's call it the last third of the month tends to be fairly flat here. If we look at the bars down here on this graph here, this is a daily gain, a frequency gain of being positive or negative. You can see here the positive bars represent above 50% of the time. The first trading day in this case, or the second trading day, was positive. And we see a lot of strong bars here, which represent a large number of days in the first half to two-thirds of the month tend to be positive. And then we see the occasional one in the second half to two-thirds of the month being weaker or slightly negative overall, but still a few positive bars, but definitely the first part of the month tends to be positive and quite strong here on this graph, and it corroborates what we see up in this graph here. So why do we see this strong performance heading in the first half to two-thirds of April? That really comes down to the earnings month effect, where April is an earnings month, and investors tend to want to get into the stock market ahead of earnings, hoping that the earnings will help to drive the stock market higher. I'm going to talk a little bit about what is going to be critical here, because I think if we take a look at the financial sector in the U.S., the big banks in the U.S., they kick off the earnings season unofficially. And we've had some problems in that banking sector recently, and they're going to really drive the markets one way or the other. I think really help with the narrative for the month of April for the stock market. So we'll talk a little bit about that later on. If we take a look at this is the chart showing the ranking of the average performance from 1990 to 2022. And here you can see on average, the energy sector tends to be perform well in this month. And at the beginning of April, we saw OPEC Plus actually cut over 1 million barrels of production, announced that was going to take place. And that's really helped to give the energy sector a boost here. And the energy sector has been struggling just a little bit, not much, but just a little bit, and been volatile up until that as well. Now it's been 64% of the time has outperformed the S&P 500. So this last column here represents the frequency of outperforming the S&P 500, and these sectors are ranked. And these are just the major sectors of the market, and they're ranked according to average gain here. Material sector tends to perform well. Consumer discretionary sector has been outperforming the S&P 500 recently. It also tends to perform well. Financials also tends to perform well, but I want to put a caveat here and say that this really is the first half of the month for the financial sector. In fact, I'm going to jump right now over to later on in the book when I discuss the financial sector for the from a seasonal point of view. Here you can see the financial sector on a monthly basis. You can see here on average, you can see that so the bar is the financial sector, and the diamond is the S&P 500. So you see the bar quite strong here. So on average, it does tend to beat the S&P 500. The median tends to be below the S&P 500, though, so something to watch out for. So when the financial sector performs well, it can really perform well, and when it doesn't do so well, it can, not perform poorly. And so there's a wide dispersion of returns that are driving this here. And so we're going to have to watch out for this time around. And also, just to show you this graph here, we do see relative to the S&P 500 that in April, we do see that we start to see this downtrend starting to happen for the financial sector. So although it is in the top part of this chart here, still you have to watch it, and it finishes up shortly, and a lot's going to depend on the earnings announcements coming out from the big banks. If we take a look at some of the weaker sectors here, utilities is down lower here, and that's really towards the second part of the month too. Healthcare, consumer staples, telecom. So we're really looking at defensive sectors tend to not perform so well relative to the S&P 500 in the month of April. If we take a look at some of the just the selected subsectors, look at the auto sector here. The auto sector tends to perform well in this month here, but it's only 48% of the time. So less than half of the time does it outperform the S&P 500. And you can see here in 2022, it really got crunched actually as well. So once again, when you see this number below 50% or not have a high number and it's outperforming on an average basis, it just says the dispersion of returns can be quite large. And if we go down to the lower on here, down here, we can see that gold and silver tend to be here. Look at biotech way down here on this chart here as well. Now, just a caution, biotech does start a strong seasonal period in June. It can sometimes start in May as well. So if we do see a big pullback for biotech, we could actually see a good setup for an opportunity to get into the market. Gold and silver, the gold's actually been doing quite well recently through the banking crisis. A lot of people have been shuffling funds into gold. We've seen a lot of central banks around the world buying up gold as well. So although April tends to be a weaker month of the year for gold, it's still positive on average. At least from a longer term perspective, but it tends not to make its big, huge gains in this particular month. Okay, let's flip the page and take a look at some of the sectors here. So in the month of April, we got the 18-day earnings month effect, and this is what I was talking about for April. In earnings months, so in this case, January, April, July, and October, you see the first part of the month, and I've got 18 calendar days, so about approximately 2/3 of the way through the month, you tend to find that the stock market tends to perform well coming into earnings. Let's flip the page again and go over to consumer staples. Now, consumer staples, I just said that consumer staples was one of the weaker sectors in the month, but I just want to point out here that consumer staples starts its strong seasonal period on April 25th, so later on in the month, you find that, and particularly if you see the rotation from the consumer discretionary into the staples. Now, that may happen earlier if the market gets into trouble as well, particularly if we find the banks coming out with weaker earnings, we could see more of a shift into consumer staples. And consumer staples has actually been performing okay recently as investors have really tried to position their portfolio. Let's flip the page again and go over to government bonds. Now, we're getting ahead of ourselves here but it's still good to take a look here. The seasonal period for government bond strength starts on May 6th and runs until October 3rd. Now, I do want to say here, and I did this very different in the book. I've separated out August 9th to October the 3rd here in the book on purpose, and it's still part of this May 6th to October 8th, and then we go to August 9th to October 3rd. So these periods are connected. They're not discrete the way I've done them in the book. The reason I did that was to show you that the sweet spot is for this trade really is later on, and you see some high percentage gains here and also a positive frequency as well. And you can see here in this chart here that here's August. The month of August tends to be the real sweet spot for the U.S. government bond sector as well. Now, so it starts in May, so maybe it starts early this year. We're not sure. I think here we are in April, 1 month away from this. And if we start to see the market roll over a little bit early, we could see some movement into government bonds. Let's flip the page again. Okay, there's American Express. If you want to take a look at American Express, you're going to have to do that on your own. Okay, so let's take a look at some of the sectors in the market that I just discussed here. We're looking at the financial sector using ETF in the States, XLF. And we can see here the banking crisis that unfolded. And this is relative to the S&P 500 here. We can see that the banking sector. Now, it's interesting. Even the banking sector stabilized a little bit with a few band-aids put on by the Federal Reserve, the Treasury Department, the FDIC. But we haven't seen outperformance, but it has shown some stability. But watch out for those earnings coming up. That could change either way here. Here's the energy sector using the ETF XLE in the States, and this is relative to the S&P 500. Interestingly enough, we've seen the energy sector underperform the S&P 500 really since last November. It did start a strong seasonal period in February, and we did see some up and down here. We have seen this uptick recently here, very recently, as the sector has managed to get a bit of strength with the OPEC plus cuts. Now, that OPEC is really the narrative there is they're saying, well, we're anticipating a weaker economy, so we have to cut. So we're making a preemptive action. Right now, the market sees this as a good thing, but it's going to be interesting to see how this plays out a little bit longer. April tends to be a strong month for the energy sector. Sometimes the energy sector can actually roll its seasonal period past the beginning of May and into June with strong momentum. I'm not sure it's got the tailwinds to do that this year. That's something we'd have to judge a little bit later on. We are seeing some positive action at this time, though. Here's the material sector, and the material sector with using the ETF in the States, XLB, and here's XLB relative to the S&P 500. I want to point out a couple things here. First of all, the material sector, when it corrects, we tend to find these re-ratings happen really quickly, and actually it can be brutal for the sector overall. It's often a reflection of investors switching into the narrative of a weaker economy and impacting the markets. And then we see these re-ratings that happen, and we get this sawtooth pattern, and we get the big re-ratings. And this is relative to the S&P 500. Well, look what happened in March. In the beginning of March, as the banking crisis unfolded particularly, that really put pressure on the material sector. And investors were concerned that the banking situation was really going to hinder the economy overall, and they took it out of the material sector. We have seen some stability in the material sector relative to the S&P 500. It tends to be one of the better performing sectors in April. We'll have to see if it can maintain that. It finishes a strong seasonal period May 5th. So maybe, the month of April might be good for the sector, but it probably does not have an expiry date much past that if it can get that far. Here's the consumer staples using the ETF XLP, and this is XLP relative to the S&P 500. And you can see, look what happened here in January, strong underperformance for the consumer staples sector. And then since then, though, we've seen the sector actually outperform the S&P 500. Investors have really been trying to figure out which part of the market they want to be in. And recently, it's for the last few weeks, it's been technology. But they stayed away from technology earlier in the year, in January a little bit. So it's been dancing around. And as a result, we've seen some of the defensive sectors actually perform well in this process. Not obviously for the XLP in this time period, but we are starting to see some stability for the sector heading into a strong seasonal period, which starts later this month. Now, as I pointed out when I was showing you the chart of all the different sectors and the relative performance, we can see some weaker performance for the consumer staple sector, but that's in the first part of the month. And that's in contrast to what we see for the overall market, because we see on average the market tends to be quite strong actually in the first 2/3 of the month. And as a result, in that risk-on environment, investors move away from consumer staples typically. But if we tend to start to challenge that narrative a little bit later on, perhaps as earnings start to unfold here, maybe the consumer staple starts to pick up here even further relative to the S&P 500. Here's a U.S. government bond, 7 to 10 year. I'm using the ETF IEF in the States. We can see this really, and this is just absolute performance, negative performance over the last few years here. But we did find that bottom that took place in October. And this was really based upon the narrative that the Federal Reserve is going to have to cut rates at some point. And so we saw this response take place. And then, the challenge that took place really in February, that the Federal Reserve is really going to have to remain hawkish. But in March, we saw the bank crisis earlier in the month drive bonds higher at this point. So where do we go from here for government bonds? We're just about a month away, really, from the start of the strong seasonal period. And I think if we do see the market perform well in April, the first part of April, government bonds will lag at that point. But if the market does start to roll over, we have a little bit of time where government bonds can actually start to stabilize and perform well. So if we see the stock market start to get in trouble coming up shortly over the next few weeks or a month or so, we could see a government bond start to be a recipient of that, or at least a beneficiary of that. I want to show this graph of the Canadian dollar. This is relative to the US dollar. And the reason being is April tends to be the strongest month of the year for the Canadian dollar. In fact, it has a strong seasonal period relative to the US dollar from mid-March until the end of April. And it was almost bang on this year, actually. If you can take a look here. And I've also plotted the price of crude oil here, because it's one of the major driving factors for the Canadian dollar. When you see a large move in the price of crude, you often see a corresponding reaction in the Canadian dollar as well. It's not the only factor, but it is one of the larger ones. And if you take a look here, we can see that we've seen the Canadian dollar actually consolidate over the last little while, really from last year in October. But mid-March, that's when the strong seasonal period starts. And right on cue, we saw the Canadian dollar start to improve in strength here. And here we are in April. And we're seeing a little bit of strength in the price of crude here taking place, and this is helping to boost the Canadian dollar this time. But the warning here is that in early May, typically the Canadian dollar doesn't follow along with a strong performance starting in May. So particularly if the stock market starts to get into trouble here a little bit and starts to become more volatile, investors tend to rush into some of the U.S. holdings, driving up the U.S. dollar as well. So right now we are really starting off that real sweet spot for the seasonal period of strength for the Canadian dollar, which is the month of April. So where do we stand in the market this month, the month of April? I do want to point out that we're about, well, just approximately 1 month away from the end of the 6-month favorable period for the stock market, which lasts from late October until early May. And yes, the stock market can move higher into June and July, but most of the gains typically have taken place up until early May. Now, we do have the earnings coming up very shortly, so Q1 earnings, and I've talked a little bit about that in this video. And I really believe that the banks here are really going to be a big catalyst for the stock market. And this can go either way. So if the banks come out and start reporting stronger than expected earnings and come up with positive comments and really quell the whole concern about the banking crisis that we had, the mini banking crisis, if you want to call it that, in March, then I think that could help the market really start to at least have a rally in the short term and perform well into May and maybe even into June as well. On the other hand, if they come out and start to talk about a slowing economy and cutting jobs and taking bigger loan loss provisions, or money leaving the banks, or come out with an overall negative narrative to their earnings, that I think could have an impact on the market. And some of the other companies obviously could come up with stronger earnings, et cetera. But right now the focus is on the banks and the financial system. So we could see maybe the market doesn't make it until May 5th this year, or maybe it blows up way past May 5th on a strong rally. So to finish off that 6-month strong seasonal period for the stock market, I think it really comes down to the bank earnings. I do want to point out that the last earnings, Q4 earnings in 2022, 67% of the S&P 500 companies, according to Refinitiv, beat their expectations. Now, that may sound like a lot, but it's actually below the average. They were not stellar earnings. We're expecting actually a contraction. Refinitiv is expecting a contraction in earnings in Q1 on a year-over-year basis. Now, the pandemic has sort of made that hard to have comparisons here. But the earnings aren't expected to be stellar at this point. And if we see a contraction on an absolute basis, nominal basis, I should say, on a year-over-year basis, that might scare a little bit of investors as well. So, and we're seeing a lot of economic signals in the marketplace. Now, I do want to say that, you can really find charts to show anything in the market. If, you really want to show a bullish picture, you can go off and find a whole bunch of bullish charts if you dig deep enough, or bearish charts. You sort of have to follow the same stable of charts. Whether it's the ISM or Empire Manufacturing Index, whatever it is, and continually look at those and track whatever that stable is. And the indicators that I'm following do show that the economy is slipping a little bit here. And it's not showing up in the stock market. And I really believe that the inflection point where people will start to get concerned is when the unemployment number starts to trend higher. Maybe not the first unemployment report where it comes up a little bit higher than expected. When we start to see 2 or 3 unemployment reports where the unemployment number has moved higher, that's when I think the narrative is going to change. So, and we might see a reflection come back. I mean, right now the economy's okay, GDP-wise, but we're seeing all these soft indicators that are really reporting a weaker economy here. But more importantly, from a seasonal basis, we do see the stock market tending to perform well in the first part of the month. If it doesn't, that really tells you something that where investors are starting to become a little bit negative here. But I do believe the real focus is going to be on the bank earnings this particular quarter, and it's going to be something to watch for. Thank you very much for joining me today.